Hello, accounting students. Welcome to Chapter 14, Accounting for Uncollectible Accounts Receivable. Lesson 1 here is uncollectible accounts receivable and really determining what is going on with some of the accounts at a business where we might not be able to collect money that is owed to us as the business. So we definitely want to be thinking about why it is that businesses allow customers to buy on account and why it is that in some cases individuals or businesses can't pay their balances that are due within a certain business. So, as we think about even just the concept of an IOU, sometimes people don't pay back the money that they owe us. And so we have to consider what is it that we do from a business perspective when that happens. So our three objectives for this particular lesson would be to explain the purpose of the allowance method for recording losses from uncollectible accounts, estimate uncollectible accounts expense using an aging of accounts receivable, and then recording the adjusting entry for the allowance for uncollectible accounts. All right, first, the allowance method of recording losses from uncollectible accounts. Accounts receivable that we simply cannot collect the money from an individual or a business is called an uncollectible account. And sometimes businesses call this stuff bad debt. And we just realize that we're not ever going to be able to collect the money. So rather than spending any more of the business's valuable time, they write off the debt. And then going forward, they don't allow those individuals or those businesses to borrow on credit again. They just make them always pay for any materials or supplies that they would be trying to get from the business. So crediting the estimated value of uncollectible accounts to a contra account is called the allowance method of recording losses for uncollectible accounts. And we're actually going to see that in practice. So when we're talking about value as it relates to a business, the difference between an assets account balance and the related contra account balance is called the book value. So when you're talking about, hey, here's what it says that we are owed, but we recognize we're going to have to write some of that off. And the difference between that then is the book value. And the difference between the balance of the accounts receivable and the contra account is the book value of accounts receivable. So the amount of the accounts receivable that a business expects to collect, they call the net realizable value. So in reality, we recognize as a business that we're probably going to end up writing off some of our accounts receivable. We just realize in some cases that there will be some debt that we just can't collect. And when that's the case, then we understand we have a realizable value that we actually will be able to collect. So there are two methods to figure this out. One of these is the percentage of sales method, which is actually pretty easy, and you just kind of go ahead and establish a value based on your ability to collect previously, and you kind of just go ahead and say a percentage of all our sales is going to be uncollectible, and that's what we anticipate we're going to be writing off. The other one is the percent of accounts receivable method that really analyzes accounts to be able to estimate how much is going to be uncollectible. So when you do that, analyzing your accounts receivable, what you do is you look at how old the accounts receivable balances are. And so you age them out and you determine, and typically in bands of 30 days, this debt is less than 30 days old, this is 30 to 60, 60 to 90, 90 to 120, over 120. And some businesses characterize anything over 90 days old. And you can imagine once a debt gets to be 90 days old, it's much more likely that you're going to have to write that debt off. And so the older a debt is, the higher likelihood that you're going to be writing that debt off, or that you're going to be considering that that debt is uncollectible. So when you go ahead and do that estimating of your uncollectible accounts, you just go ahead and put all of your customers in one chart, and then you age out the balance of money that they owe you. So you can see we have lots of current, we have a few accounts that are in that 0 to 30 day window, and we only write off, say, 1% of our current, 4% of our 1 to 30, anything 30 to 60, we have a higher likelihood. But then you can see that things over 90 days old, we're anticipating that we might have to write off 80% of that debt. So what happens here is that we run some numbers and we calculate what's 1% of our current and 4% of the 0 to 30, 12%, and then 30%, and then 80%. And we figure out that we currently would have an uncollectible amount of $2,509.25 right here. And then you say the current balance of allowance for uncollectible accounts is $125.15, and you subtract that. So you would say the estimated addition that we are going to have to make to our uncollectible amount is right here. Okay, so you compute what you're going to say for each age group, get the total estimate, and then figure out what do I have to add to that contra account so that I'm going ahead and posting that right amount. So here's how we would do an adjusting entry to allow for the uncollectible. So we're going to look at our accounts receivable is $20,381.81, and our uncollectible account expense is $23,84.10, and originally our balance was $125.15, so we're going to add that $23,84.10 so that our new balance is $25,09.25. So in our general journal, we're going to go ahead and debit the uncollectible account expense, and then we're going to credit the allowance for uncollectible accounts. Okay. You want to remember that these are adjusting entries, so we do them at month end. And you can see the account titles, the debit, and the credit amounts. All right, so question, what general ledger accounts are used to account for uncollectible accounts receivable? And the contra asset account for allowance for uncollectible accounts, and then the expense account, uncollectible account expense. So why an adjustment for uncollectible accounts is an application of the matching expenses with revenue. So why is that? Why does this match up with the idea that we need to match expenses with revenue? This allowance method of recording losses really attempts to match up the expense for any accounts that are going to be uncollectible in the same fiscal year that the sales are recorded, realizing that we are not going to end up writing these accounts off or writing these balances off for months into the future, potentially even 3 months from now. However, we want to make sure that when the sale was actually recorded the same fiscal year, that we're going ahead and writing off that expense so that it matches up when the sale happened, that we actually wrote off the expense, or we allowed for writing off that expense back when the sale was being processed. So the two methods used to estimate uncollectible accounts receivable: percentage of sales, which is just kind of a flat amount, it's much easier to calculate, or the percent of accounts receivable, where we go ahead and age out and look at how old the accounts receivable balances are, and we run some calculations based on that information. How is accounts receivable affected by the estimate of uncollectible accounts? If the accounts receivable is not affected. All right, so if you have gotten all the way to the end of this video, What I would like for you to do is go ahead and in the comments for this video out on YouTube, just put your initials, your first initial, last initial, as I'm trying to do a little bit more tracking in terms of who's actually watching the entire video. I've been looking at the number of views the videos are getting, and it's pretty low. So if you got all the way to the end, before you go out and answer those forms, and before you go ahead and do the work together and on your own, just put your first initial and last initial in the comment section out on YouTube, and I will have a look at that later. Good luck and have fun.